everyone. Good morning. Welcome to the EBITDA, How to Calculate Earnings presentation. Danny O'Laughlin and Nick Stein with Cetane Associates, who are our two newest members, are going to be doing this presentation today. I'll let them give their introductions and backgrounds to kind of kick off the presentation. Throughout this webinar, if you have any questions, please use the chat function or the Q&A function down towards the bottom of your screen. And this should be about 20 minutes or so. After that 20 minutes, we'll stick around and answer as many questions as we can. As always, if you have any follow-up questions, don't hesitate to reach out to the Cetane group. All right, so Danny and Nick, we'll let you get going.
All right, so I'll lead this off. I'll just give a little bit of my background, then pass to Nick, and then we'll jump in to discuss EBITDA. So you can see on my resume on LinkedIn or the Cetane website, I did about 7 years in BVAL. We valued everything under the sun, liabilities, companies, derivatives, etc. Did tons of different industries as well. After that, I decided I wanted to get into the action of things. Did some buy side at Anticimex, then did a few years as the VP of M&A over at Pesco. And then decided after that I wanted to get to the sell side. Got picked up by Cetane, and now here we are. Before we jump into this, I really want to quickly note something that, I am a CPA, but I didn't know what EBITDA was until my first day at work because it's a finance term, not an accounting term. And so if you don't know what it is, don't know how to calculate it, etc., like I said, this is gonna be simple, and this is the purpose of it. So do not feel bad. I once again was finance adjacent, had no idea what it was. So we're here to learn. So I'll pass to Nick to do his background, then we'll jump in.
Yep. Hello, everyone. Nick Stein. So I have a very similar background to Danny's. I've spent my entire career valuing businesses, helping owners sell their business and buying home services companies for a private equity-backed platform. Danny and I, we've learned a lot of lessons through our combined experiences, and now we just want to impart, some of that knowledge and help owners make the right decisions for both you and your business.
Cool. And yeah, final note before we jump into the EBITDA stuff. Barrett said 20 minutes. I think it's gonna be closer to 15. So the more questions, the better. All right, so let's just, oh, there we go. Now the computer works. All right, so first, what is EBITDA? Functionally, EBITDA is an estimate of the earnings of the business that can be used across industries with minimal modification. As its inputs are generally well defined, it's also extremely useful in comparing companies in the same industry. And as it's, good for comparison, is generally standardized, is widely used to value businesses, buy side, sell side, tax reporting, whatever purpose you may have. And then lastly, it's a really rough estimation of the cash flows of the operations of the business. So all the finance people in this presentation or in this webinar right now who are going to hit me with actually no working capital, actually no whatever. This isn't what that is for. We know you can get more specific with a nice 3-statement model or LBO. We're just trying to calculate EBITDA and use it because it's the simplest and easiest across all industries without getting into really dense finance. And then the other point I'll make about EBITDA versus doing big financial models is that the more inputs, the more made up stuff. So like I said, jumping into EBITDA specifically, so it's earnings. We'll just read left to right. Earnings before interest, taxes, depreciation, amortization. And so the goal here is essentially you're trying to get to like a standardized earnings measure. And what we're doing is we're removing some items to get there. And the items that we're removing, I'll discuss why. And so we'll start with D&A. D&A is removed because it's non-cash. Taxes are special circumstances of the owner. Interests are special circumstances of the owner. And so we're trying to remove all that noise. That's why we're starting at net income, but working our way back up. And so this will make it more comparable because there's less, I guess, ownership specific items in here, and there's less way for people to play games when using EBITDA. So we'll jump right in. this is the kind of walkthrough from a high level, and then Nick will give you a numerical example. It's a lot easier with the numbers. So I'll just go over the theory though. So you want to try to start above other comprehensive income. A lot of people's books won't have OCI in it. It's a complicated accounting thing. So you're just going to start at net income. What you want is minimal noise in that number. If you have other items like gain or loss on assets, you want to start above that. I don't want to use this term because it's kind of technical, but we would typically start at NOPAT, which is net operating profit after tax. Like I said, Nick will go through that in the specific example next. So that's where your earnings starting point is. Then before, as you can read, it's before. So we're going to remove all these items and push them out to get to a before state. So interest, the theory here is that you're only pulling out your interest from structural debt because that is a choice of the business owner. For example, Nick and I run the same business. We throw off, I don't know, 250K in EBITDA, but Nick has, I don't know, $1 million in debt and I have no debt. Nick is going to have a much higher interest expense, and that's a choice of his, how he finances the business. We're going to remove this choice. So remove the interest when working your way back up. And I'll note this is only like structural debt. So if you pay some interest on credit cards, that's kind of like a cost of financing operations. So that does not count. And I keep doing that. All right. So for taxes, you're going to remove taxes also when working your way back up. This is because this is a choice. And there's like a million different ways that someone can tax structure a business. For example, your taxes could show as zero because you're pushing forward NOLs and using those. Whereas, we earned the same amount, but I paid a ton in taxes because I didn't structure it right or et cetera. I will say, and I assume given our industry focus on resi home services, I assume there's not many guns and liquor manufacturers in here, but if there are, excise taxes should remain in the business because those are a cost of doing business. So lastly is depreciation and amortization. This needs to be removed. Well, this is the blend one. It's removed partially because it's a non-cash item, and then partially because it's a choice item. There's like a million different ways to depreciate assets. People could be putting tax depreciation on their books, could be putting book depreciation on there. They could be like 168K'ing it. And so there's just a ton of variance in depreciation. And so we need to remove that as well. And then lastly is amortization. So let's assume Nick bought his company and it does 250K in earnings, but I built mine from the ground up and it does 250K in earnings. Those earnings should be equal, but Nick is going to have a huge amortization expense because he bought it. Whereas I have no capitalizable assets and I cannot amortize anything. So it just disappeared. So from there, so that's like the general high level theory. Nick is going to go through a specific example. This is going to be just so much better than the theory because putting the numbers to it makes it a lot easier to understand.
Yeah, like Danny said, now that we kind of walk through a high level, definitional, the accounting and finance stuff of what is EBITDA, why do we add back those ITDA items? We're going to kind of look at it from a numbers standpoint, what it might look like if you were to pull, your P&L from QuickBooks or whatever system. How do you work your way down the P&L? How do you find those items? And then how do you ultimately calculate EBITDA? So we will start here. And so we're going to assume in this example that this is, full year 2024. But, obviously, if you're kind of pulling this out of your system at home, you just use the last 12 months. That's usually the best time period to look at when you're looking at EBITDA. So obviously, we'll start with revenue and then we'll subtract out our cost of goods sold, and that gets us our gross profit. And then from there, we will subtract out our operating expenses. And I will note that this is usually where depreciation and amortization will live. Obviously, when you pull these reports from your system, there's usually, 20 to 30 to 40 different expense line items. And so usually depreciation and amortization is buried somewhere within those operating expenses. So I would just recommend, as you're working your way down your P&L, to just, note or highlight when you come across these items that need to be added back. And so the first one here would be depreciation and amortization. So now that we found it, we can highlight it and move on. So once you subtract out those operating expenses, including the D&A, that gets us our operating income. And then from there, we will find the interest expense if it is included in the P&L. Same thing. So just kind of note it, highlight it, and then once you subtract out that interest expense, that gets us our pre-tax income. And then obviously, if you're paying taxes through your business, and then next up will be that tax expense. I just want to kind of reiterate that this, when you're going through and highlighting it and noting it for going through the EBITDA calculation, only make sure you are highlighting that income tax, like Danny mentioned. So in this example, that tax line item is only income tax at 37,500. And so after you subtract that out, that gives us that net operating profit after tax, or NOPAT, that Danny mentioned. For this example, we are going to use that as our starting point for EBITDA, but as Danny mentioned, there can be other items before getting to net income. So just to show you that, in this example, we have a gain on a sale of asset of $15,000. Once you add that in, that gets you your net income. But like we mentioned, that is a non-cash transaction that's running through the P&L. And so therefore, we do not want to include it in our EBITDA calculation. So we will be starting with that net operating profit after tax as our earnings before. So you'll see that $112,500 is equal to that net operating profit after tax. And then from there, we kind of go back up through the P&L. We find those items that we highlighted. So, we find that interest expense that we highlighted, that 40,000, we bring it down, we add it back. Same thing with the tax, income tax only, we add that back. And then lastly, the depreciation and amortization, we add that back. And then one thing I want to note on this is that, in order to add these items back, in order to get EBITDA, they have to be an expense that's running through your P&L. So if you don't have interest expense, if you don't have, taxes running through your P&L, if you don't have D&A, maybe your accountant books at the end of the year, and so it's not in there yet, you can't add it back below the line if it isn't already an expense that's running through your business. And then kind of a few more things just while we're on this, topic of EBITDA. One thing I want to mention is that you did not hear us mention distributions at all during this webinar, and that is because, distributions are not an expense that are run through the P&L. They are an equity balance sheet line item. And since they are not expense through the P&L, like I just mentioned, they cannot be included in our EBITDA calculation. And then you also may have heard the term seller's discretionary earnings, and maybe wondering how that differs from EBITDA. So SDE is similar to EBITDA, but it includes add backs of whatever discretionary expenses an owner wants to include, hence the name seller's discretionary earnings. And so instead, we like to use an adjusted EBITDA number, where we work with the owner to prove out relevant adjustments for that particular business, as they will vary by company. One thing I will just kind of note is that, we are not the IRS, so we do not care what expenses are being run through your business, but honesty is key, as, some of those items may be able to be added back, some may not. So that's just kind of the difference between seller's discretionary earnings and EBITDA, or adjusted EBITDA in this case. And with that, I'll pass it back to Danny to kind of wrap up what we've discussed so far.
Yeah, thanks, Nick. Yeah, we did not talk about adjustments today for a specific reason, and that's time. So we'll get to that at a future webinar, how you adjust EBITDA for certain market participants, et cetera. You can get really deep into that. And so, while this was focused on calculating EBITDA from a functional standpoint, when you look at your business, there are all these adjustments when you're looking to value it for whatever purpose. And so we offer a free value range analysis in which we perform that deep dive with you, adjusting the EBITDA and then estimating the market clearing value of your business. If that's something you'd like to work on, there's a few documents you got to sign, et cetera. But please reach out after this webinar, and then I'll pass it to Barrett, who is going to run the questions.
Yeah, great job, guys. So we did get some good questions throughout. So I'll just kind of kick it off with the first one. How does EBITDA differ from the net profit, operating profit on my P&L? What does EBITDA tell someone that those do not?
Yeah, I'll take it. I mean, I kind of went over that section.
Yeah.
So the notepad, I mean, can you see my mouse? Side note?
Yep.
Yeah, so your net operating profit's right here. And so how it differs is, the essentially the ITDA, the inclusion of those line items. And the reason that we're doing away with those line items, as I mentioned previously, is that they're company specific, they're cap structure specific, and a buyer may or may not have those scenarios. So we're trying to get rid of all the company specific choices to standardize. And that, while we're on that point, I'll just keep going a bit further. That's why adjusted EBITDA is used versus SDE, is because adjusted EBITDA has a starting point at EBITDA and then is adjusted from there, whereas SDE is, well, discretionary, literally says it.
Great. So I think you guys have loosely touched on this, but I think this is the big question. Someone asked this one. Why is EBITDA the standard metric used for M&A transactions?
Is it going?
You got it.
Yeah, so I think Danny mentioned it a little bit, like you said, but it's really because it removes some of that noise and so that you can compare across different companies. So obviously, when you're going to value a business, you're going to compare to other companies, other transactions that are happening in order to value it, on top of looking at those company specific, financials, intangibles, that sort of thing. And so in order to get to a number where you can really compare across different businesses, industries, that's why that's kind of the standard. And addition, it removes some of that stuff that would go away when a buyer would come in to buy the business anyway. So there also is a sense of an element of normalizing some of those earnings to a buyer, what it would look like under their ownership going forward. So it's a combination of those two things.
Yep. I always say it's the best way to standardize across industries, across geographies, across, am I using financing and leverage or am I not? And that's why we can talk about multiples and why they are, X range for this industry and X range for this geography. And it's the best way to kind of compare everything under the sun. Nothing's perfect, right?
Yep.
All right, here's the next question. My accountant told me to minimize the profit for my business to avoid a big tax bill. So I bought things, paid out a bonus, took other deductions. How does this impact the calculation of my EBITDA?
This is something we see pretty much every time. So how does essentially stuffing the business with what I'll call extra expenses impact my EBITDA? So your EBITDA, your raw EBITDA, just straight calculated, is going to be lower than it would have if you were not adding all those expenses in. However, that's that adjustment process that we discussed briefly at the end, is that works to remove all that and get it on the business on a normal basis for a buyer. And so that's removing all that noise, and that's the adjusted EBITDA. What we did here, just for simplicity, was just raw EBITDA because we didn't want to add a layer of complexity.
Great. All right, I'll let you guys grab this. I do have some thoughts on this one. If I'm thinking of selling my business, should I invest in improving my facility or invest in new equipment? Won't that hurt my EBITDA before I try and sell?
I do this. So buyers always want to see kind of like a normal level of operations before they're buying it. And so I would just run your business as you would normally run it. If you need to upgrade your facility, if you need to buy new equipment, if you need to buy new vehicles, I would just do that as like normal course of business because that is what a buyer would expect. And they would adjust it either way depending on, whether you overinvest or whether you need to invest more in that type of stuff. So they're going to kind of normalize it anyways. So I would just continue to run your business as you would as if you weren't selling it. And that's kind of how that goes. You anything to add to that?
I'm trying not to go down the rabbit hole, but if you're gonna take bonus depreciation that I think is available for like 1 or 2 more years, that number, if you can grow the revenue with the new equipment, that depreciation expense is not going to impact your EBITDA, and so it will grow your revenue without that depreciation expense hitting. So I mean, it could be a good idea, but what I always tell people, and this should be across the entire sell side industry, is run your business as if you were going to keep running it.
Mhm.
I just think that like trying to amplify one thing or another prior to sale, especially if it's something large, is a really risky play because I mean most things do clear market, but sometimes they don't.
Yep. Spot on. Completely agree with all that. All right. So we've got another question here. As a percentage of NOI, where do you guys see SDE, sellers discretionary earnings, at when valuing propane marketers? So I will grab this one as I've
Oh,
got a little more um, knowledge on that. So I think if I'm being kind of frank, we don't typically get to the seller's discretionary earnings. So we don't typically compare that as far as net operating income. I would say it really runs the gamut. It can be anywhere from spot on, and there's not much going in there, to we've seen some pretty big, multiple $1 million of discretionary items thrown into that number. So it really does run the gamut. Again, we're not the IRS and we're not your accountant, so we're not here to scrutinize what those are, but it can kind of vary across the board. Um, let's see.
but also an added comment on that, like that amplified variance is why you try not to use SDE also, just to add to that.
Yep, yep, great point. So I have, let's see here. Am I oversimplifying? But it looks like you can arrive at the same EBITDA number by taking gross profit minus operating expenses. So I think in that case, we're missing.
No, it's fine. It's because it's a simplified example and there aren't any items buried elsewhere. And I will say also, if you have just straight cash books with no taxes and whatnot in it, and you don't bury your depreciation, everything's called out pretty simply, your essentially operating profit is your EBITDA. In this simplified example, you are correct. You can do that. I'll tell you, they never look like this, and it's always buried. And like for example, there might be, once again, try not to rabbit hole, but in GAAP, a lot of your depreciation is going to be up in COGS and in OpEx simultaneously. And so but yes, for this example, you could in theory do that. And if you run simple books, it's going to be pretty close.
Yeah, I'll add to that. We've seen expenses all over the place, COGS down below, OpEx, all over the place, other expenses, other income. And so it's just usually easier just to work through the P&L like this, just so you're not missing anything. Because, I've definitely seen that happen where things get missed because they're, like Danny said, they're buried somewhere else. So ideally it's as clean as that, but it's not always as clean as that. So it's just easier just to kind of work through the way that we did it, just to make sure you're not missing anything.
Yep, we've got one more that I know you guys have touched on, but just want to clarify. I thought owner salary was added back to EBITDA. I think this is just the difference between that adjusted EBITDA that Nick and Danny were referencing versus this is the simple straight line EBITDA, the calculation that you have. Any other notes on that one?
Yeah, I'll add that it's not always an add back. If you work 65 hours a week in your business and they got to replace you with a GM, you are not an add back. Sorry.
Yeah,
Yeah, I think that's why I mentioned, we didn't want to touch on the adjustments too much because it is a case by case thing. It varies by company. And so, meeting with an advisor like ourselves, and actually working through those adjustments is really important to kind of understand what can be added back and what can't.
we've got one more here that this might be a little complicated for this, but let's see what you guys think. What items are in a traditional cash flow that are not part of EBITDA?
Oh, nice.
That's a good one. You got this.
That is a good one. That was what I kind of alluded to at the very beginning. So it'll be change in working capital, and then CapEx are your two majors. But if you're running like a full LBO, you're going to charge your rent expense yourself, et cetera. But it's pretty much just working capital and CapEx.
Yeah.
Great. I think we've knocked out most of the questions we've gotten, and we're at 25 minutes, I think, from the top of the hour. So we went a little longer than the 20 minutes that we promised. Thank you everyone for joining today. As Nick and Danny said, if you have any questions, do not hesitate to reach out. We've got, I think, a QR code here to find our website, and then Danny and Nick's contact information if you ever want to talk to anyone else at Cetane. Hopefully we're not too hard to find. So again, thank you everyone for joining. We'll try and do a couple more of these over the next couple months, just because I think they're pretty educational. And yeah, thanks so much, Nick, Danny.
Thanks all.
Thank you guys.
Thanks everyone.
Bye.